the week ahead. There are two parts to this week's recording. The short action part and my reflection on the current market. For the short action part, if you see the graphic, the market low on Friday was exactly on the trend line. Remaining above the trend line keeps the rally intact. Looking below the trend line, the market can either reject the look below the trend line, or it can accept it and see additional downward range extension. The FOMC meeting is on Wednesday, with the announcement of the results of the meeting Wednesday afternoon, followed by the chairman's conference. If any institutional money wants to make adjustments prior to the FOMC meeting, usually those adjustments are made at least 2 days before the meeting. The reason being that the day before the meeting, the markets are usually fairly thin. So if there is adjustments that they want to make, it could well happen on Monday. When I look at this, it's the short version. We're on the trend line. You know, the trend line either holds, we rally from the trend line, or we look below the trend line and find acceptance to the downside. That's the short version. What I have been spending more time discussing is the overall view of the market. And granted, you could classify this as a bias because this is my view. I see equity markets in the final stages of the rally. In a final stage, the market is usually being taken higher by laggards. When I talk about laggards, they are usually the smaller individuals, late to the party, and they are being driven by FOMO. The signs that support this view include an increase in call option buying. In fact, it was reported last week that option volume was about equal to NYSE volume, not to mention how much attention is being given to the zero-dated options. Additionally, there were reports that the call option buying, while intense, saw a large decrease in individual order size. The decrease in order size is mostly attributed, at least in my experience, to smaller individual buyers. Then these again would fall into the category of being the late buyers or the laggards. Brokerage firms that historically attract smaller traders are showing strong new account openings from any information that I have. Additionally, it was reported that Goldman Sachs is advising clients to hedge their portfolio. When I look at this over the last several days, the market has come into short-term balance. Generally, what happens, markets go from trend to balance, resolve back to the upside, or trend balance to the downside. So if the market, if I'm right on my overall assessment, one of these days, it doesn't necessarily have to be this week, but one of these days the market will break to the downside, and that should set up a trading range and gives the market a time to adjust to some new views at the time. All right, that is where I'm standing on the market. The last thing I want to say is last week, I said that it was the probably best opportunity to start a correction that I had seen in some period of time. Monday accommodated that view, selling off. However, on the sell-off on Monday, the market went down to an exact reference point, which was seen on the March contract. From there, it cleaned up a non-excess low. We got single prints to show excess, and then the market rotated back up towards the higher extreme. But it did not take out the all-time high. Have a great week, and we'll talk to you again next weekend.